Yeah, when we've got one, we're just starting off now. If you want to lay out like a little introduction to the whole thing, that'll be good.
Yeah, sure. I'll introduce myself for those who are maybe tuning in, listening to me for the first time. My name is DK. I am Chief Strategy Officer at DeFi Dev Corp and a core founding contributor of Apex. For those who don't know what Apex is, please tune in today at 4 p.m. Pacific for on the Bitcoin for Corporations live stream at Strategy World. We'll be presenting a little bit on it today, and that's all I'll say on that. Prior to being a chief strategy officer at DeFi Dev Corp, I was head of strategy at Kraken Crypto Exchange for a brief period of time, and on the corporate strategy team for about 3 years there, and did about 8 years in long short equity before that. So I really like to think that my roots, the way I think, are very rooted in just fundamentals, old school fundamentals, and I covered technology, media, and telecom stocks. So putting out this piece on Solana was like a really cool way to sit there, put on my fundamental hat, and say like, how would I think about this if I was still, full time on the buy side, and trying to come up with a way that values Sol, giving it credit for, I'm going to say, what it will become in the future rather than hyper focusing on just what it does today, which is, I think, a little bit of a near term view. And also coming up with a valuation methodology that I think probably best represents how you would value the digital commodity of an infrastructure layer or network like Solana, rather than taking some of these, I'm going to say, traditional valuation approaches, which work very well for their respective asset classes, but kind of run into some key issues, if you will, when applied to crypto. So that's a little bit of the background on me and what we're going to be talking about today.
You want me to run a little bit? Let me talk about where we are coming into this. Let's talk about current fundamental valuations, a little background. So layer one blockchain native tokens, we're talking specifically about L1 native tokens, right? Such as Ethereum, Solana, etc., represent the core cryptos of independent blockchain networks. Unlike speculative trading based on market sentiment, there's fundamental valuations, and we aim to assess the intrinsic worth based on these are the most important things to understand: underlying economic activity, network utility, scarcity. Okay, so this is like treating these things as a sort of a hybrid of currencies, commodities, and capital assets, rather than like traditional stocks. Is that correct? I mean, and I think that's a lot
Yeah,
of people to get their head around.
that's really, I mean, hitting the nail on the head, Marty. Like the way we sort of introduced this and presented some background or context is when you think about equities, it's very easy to apply, I'm going to say, discounted cash flow analyses, revenue multiples, price to earning multiples, because um, the companies that are represented by said equity securities generate earnings that belong to shareholders or claimable cash flows, et cetera. Versus if you were to try to value a commodity like gold, oil, right? Those are much more supply demand driven, right? They don't produce cash flows in themselves. So the value is really set by how much of the commodity exists relative to how many people want or need it. And then you have this really funny dynamic with real estate, right? Where it kind of sits somewhere in the middle, right? You obviously have a lot of folks who buy properties to rent it out, and you can say, all right, well, income producing properties can be valued on rental yield, but the vast majority of people, buy a home because they just want to live in it, right? Land and owner occupied properties are purely priced on scarcity, demand for, say, a particular location, etc. So the challenge I find with valuing layer one tokens like Solana is that they don't really cleanly fit into any one of those categories. I'm reminded of like my toddler has this like a train set, and on the train set there are these shapes, and like the circle shape fits very well on the circle part of the train, and the square fits very well on the square part of the train. Solana's like taking this very like amorphous thing that is ever changing and trying to like jam it into one of those square pegs, and it doesn't quite work. Point number one being Sol is not an equity, right? There's no like claim on earnings. It's not like, you know, token holders have, you know, a legal claim on cash flows or earnings, et cetera, right? And it's obviously not currency in the traditional sense as we've come to understand it. And it's also not a pure commodity, right? We wouldn't ever go and say, you know, Sol should be compared to Bitcoin, right? We've been the ones pounding the table on, um, you know, Bitcoin stores value, Solana moves it. So I think what you've seen is, as a result of all this, analysts have tried to borrow frameworks from all these adjacent asset classes that we've been talking about, DCFs, revenue multiples, the monetary equation of exchange, which we reference in our essay as well, and we'll dive into in a second, and tried to adapt them to layer one tokens. And again, each one has some merit, but there are some fundamental issues with trying to jam the I'm going to say piece of Play-Doh or clay onto the square peg on a toy train, to stick with my my toddler metaphor there. So again, a little bit of background on that, but I think your framing was absolutely correct, Marty.
Yeah, I mean, to continue, just from my experience, the current fundamental ways that we value these things all come from TradFi. I think it's just sort of people taking TradFi examples and trying to apply it to crypto. So that's things like discounted cash flow, right? DCF. And that's
Yep.
where you sort of try and estimate the future cash flows similar to valuing a business. So you're like, okay, transaction fees, staking rewards, protocol revenue. How does that
Hmm.
to the token holders? Things like that. But I mean, that's one way, and I think it gives like a quantifiable anchor, but it overestimates network activity stalls and things like that. I think it's a good start, but I think it's not great. Personally, I don't.
Agreed.
Well,
Agreed. Marty,
almost,
remind me, before you got into
go
crypto,
ahead.
you were at a software company yourself, weren't you?
Yeah, I was a CTO of Oracle and then the CTO of Fiserv.
Interesting. Okay, so this will I'm going to give a little bit of a technology stock
Yeah, go
example.
ahead.
And I think this may resonate with you from your time at Oracle, even though this business model, this business case I'm about to talk about is a little bit different. And the point I want to make here is DCFs work great for equities. In fact, every, you know, long only has a DCF on their core positions and their watch lists and everything. But they are also still inherently imperfect. And the example I want to give here is Netflix. And if we go back in time, in late 2011, Reed Hastings at Netflix announced his plans to split off its DVD business into Quickster. And I think they had just like come off of raising prices on their business something like 60%. So uh and the idea here was they were to split off Quickster and like have like the core Netflix business be entirely focused on streaming. So that year the stock absolutely cratered. I think it fell something like 75, 80%. It was actually so bad that some shareholders ended up calling Reed, and Reed actually reversed the decision. But even though he reversed the decision and kept the DVD business under one roof, the strategy pivot ended up being the same. He said, let's create a brand new business. This thing will be much, much bigger than the DVD, the physical rental business. Um, but we are going to have to invest a shit ton of money over the next decade, not over the next 2 years, 3 years, but over the next like 5 or 10 years. And if you had to guess, how many years would you guess Netflix, starting in 2011, spent in negative free cash flow territory? How many years was it, Marty? Random guess.
4 years.
4 years. No, they spent the next decade in negative free cash flow territory. I think 2020 was the exception, right? But that's because they had you know, everyone was stuck at home. There's a whole huge pull forward of demand, but they didn't consistently become free cash flow positive again until 2022.
Good
And
Lord.
I mention this as an important point because the stock worked beautifully, and no DCF would have told you that that stock was going to work. Why? Because if you have no cash flows, your DCF is going to spit out a whole hunk of garbage, right? Like literally negative free cash flow over the next 10 years. There was no DCF, right? And again, I mention this because it was so early in 2011. And if you believed in the clarity of Reed's vision, if you believed in what this thing was going to be, no DCF was going to tell you how good that stock was going to be.
No.
And I think that same parallel actually applies to Solana today, right? This is a 50 billion market cap right now. And I don't know. This is a network with a token that, in my view, given all of the stuff that's happening in agentic AI, the growth in stablecoins, real world asset tokenization, there's going to be so much demand for space in this digital city, as we've called it in our essay. I don't know. The token for me easily is a 20x from here. That's like almost a given, not financial advice, do your own research, et cetera, et cetera. But um, I don't know. Like for me, drawing the parallel to Netflix tells me like if you are just focused on what the network is doing right now, right here today, you are missing the grand vision for internet capital markets and what this thing will become.
Yeah, I couldn't agree more. I mean, we should talk a little bit about how these networks accrue revenue and make money, and also the effects of obviously agentic and stablecoin economies, which I think people
Yes.
credit. I think once again, price makes narrative. I'm a big believer in that, and I think you know the whole Solana as a meme coin chain thing just flows along with the price. So
Hmm.
when it does well and goes towards 200, everyone goes, "Oh, it's because of meme coin activity." Then when it comes back down under 100, people say, "Oh, it's meme coins are dead," and that whole narrative sort of creates the current speculative valuation, I think. But
Yeah.
if we move into the actual real use cases, and I believe that meme coins are really just a liveness test for Solana used to, in software, you need to find a test user base, and you can't do it with valuable data. You need functionality. You have to find some kind of a simulation, and I think meme coins are a
Hmm.
terrific simulation, right? They're perceive value entirely. They have literally zero intrinsic value on their own. And so, there's not much to lose. So you throw them out there into the world, test the network, see what it does under scale, fix the bugs, increase the fix the performance issues, the bottlenecks, the edge cases, and then unleash tokenized equity, tokenized fiat, and tokenized everything onto the same exact plumbing you've just built for meme coins, and there you go. You've tested and created a machine that can easily support the future economy. And so I
Yeah.
think you want to talk a little bit about that. The
Yeah. Let's go
value
to
accrual, like value accrual in a real
let's go
world.
to to bare basics and what is sort of historically been the way folks have looked at this. So let's talk about DCF. But before we can even talk about DCF, we got to talk about, as you said, like how does the network even make money? So to start, you've got your base transaction fees, right? Like every transaction pays some small fee on Solana. Half the base fees are burned, removed from the supply, and then half go to the validators. Then you have priority fees, right? So, you can pay extra to get your transaction process faster. Since SIMD 96 in early last year, basically 100% of these priority fees go to the validators. And then there's MEV tips, right? Like validators capture value from transaction ordering, arbitrage liquidations. Jito tips are the primary mechanism here. And of course, you have inflation, staking rewards, new soul, issued to stakers. It's not revenue in the traditional sense, right? It's just like a subsidy paid by the holders to those who are securing the network. The key point is that the network generates real economic activity, but none of it flows to the token holder the way earnings flow to a shareholder, right? And that is a fundamental like problem with trying to use the DCF approach, right? All that economic activity we're talking about, it flows to validators, gets burned, it's competed away, and like in my mind, this is why the DCF breaks. Is one of several reasons why the DCF breaks when you're trying to say, oh well, let's just take the fees and pretend they're cash flows and kind of go from there. Um, the other thing too to keep in mind is a DCF is meant to value a cash flowing entity with costs, reinvestment, distributable cash flow that can be allocated by a management team, right? They can decide to use the cash flows to pay off debt, to execute share repurchases, whatever it is. Sol is a network commodity, right? It's a staking asset. It's not a firm with distributable earnings where you've got some management team going and making the calls here. So in my mind, like those are some of the, I'm going to say from a like first principle standpoint, that's kind of where it breaks. The other thing too, I mean, to get like really into the nitty gritty here in equities, you discount those future cash flows, right, by a weighted average cost of capital, which anchors on the type of business, the type of risk they're taking on, their exact capital structure, mix of debt and equity, etc. Um, for Sol, you're kind of, how would I put it, like discounting a reflexive asset whose risk is actually tied to its own like price, liquidity, leverage in the ecosystem. It's hard to kind of like defend with any, I'm going to say like stable weighted average cost of capital input that would normally go into that. And what I mean by reflexivity is like the price actually impacts the fundamentals. It's a little like weird recursion. We talk about this internally a lot, actually. Like, obviously, higher SOL price will result in higher validator economics in dollar terms. You get more dev incentives, and that like feedback loop kind of violates the principle of exogenous cash flow that is baked into most discounted cash flows. So, um, again, that's a bit on like how the network makes money, but still like trying to draw that parallel and just sort of hand waving and saying, let us treat this as free cash flow, I think runs into some logical issues.
Terrific. That's good stuff. Then I know there's other valuation methods. Maybe you can talk through those. There's the network value per transaction, the NVT ratio. Have you heard of that one?
Which ratio, Marty?
They basically took the TradFi price to sales ratio. So, and made it they call it network value to transaction. So that's where you take
yeah.
That's another one. It's very applicable more to, I think, BTC typically. There's that one. Then there's price to earnings, obviously, price to fees. So they took price to earnings and called it price to fees. So just a direct.
Who's the one who, now that you're mentioning the network value to transactions, I remember that was like pretty popular back in, that was like a couple cycles ago, right? Like back around 2018, I think people were using that as a fundamental valuation metric for crypto. Is that right, Marty?
Yeah, I mean, I kind of like some parts of it. I think NVT was like market cap divided by daily transactional volume, average some kind of period, things like that. I mean, these are all, I think there's pieces in each of these that will ultimately go in the final sort of best practice valuation methods. Obviously, network value.
It's interesting.
Price, and then like stock to flow, right? Also stock to flow.
Yeah, I'm thinking about that now. So, all right, so this actually gets a little bit into the MV equals PQ methodology, but I'll talk about that next. So let's talk about the MVT one, right? I like it because it's actually really simple, super intuitive. It's not, it's just a very basic equation. And it's easy, obviously, to compare across chains, but you run into some, I guess, what would I call it, like definitional problems. First of all, what's going to count as a transaction, right? Like if you have a tenth of a cent vote transaction and a $50 million token swap, right? Both of those count as one transaction. Or am I going to use the actual transaction count? Do I volume adjust? Which volume am I going to anchor to? Like, I think each choice that you make for MVT there for Solana, especially where the activity is so high, can obviously swing the valuation metric pretty considerably. And then, of course, like there's, I can already hear folks going and saying like, oh, well, validator vote transactions are such a high proportion of total transactions on Solana, like strip those out and the numbers are going to look different, et cetera, et cetera. So, I can see how that runs into, again, there's beauty and simplicity, but when you have one or two variables that can like drastically swing the equation, it can really become, I'm going to say, problematic. Now, that's not to say our model, which we'll double click on here in a second, like doesn't also have some variables with high sensitivity, but there are a lot of them, which is to say, and there are a lot of them where I think we were fairly conservative, anchored in observable activity today, and tried to be as clear cut with our definitions as possible. So, what's another example of a methodology that is beautiful in its simplicity, but I think runs into a fundamental issue I alluded to in the beginning, is monetary equation of exchange, or MV equals PQ, which for those who are unfamiliar says, all right, the total amount of money spent, M times V, should be equal to the nominal value of goods and services sold. So in this, M is your supply, V is velocity, or the rate at which said supply is changing hands. P is price, Q is quantity of output, etc. The issue with this one is that velocity basically becomes the whole model. And again, you run into the fundamental issue of what are you going to define as velocity up front, right? In crypto, this can really vary. Are we counting exchange trades? Are we like, how do you count staking and unstaking activity? There's just these small definitional choices on what is going to count, quote unquote, changing hands can very much influence the velocity variable. But the more fundamental issue is that for a chain like Solana, where there's a lot of activity, a lot of stuff going on, the higher V is, the more capped your market cap is because of the inverse relationship that exists between the two. So even if the economic output of the network is crazy good, if the token is changing hands a ton, however you define it, you're going to chronically undervalue the market cap of the network. And again, I think this comes down to modeling these tokens almost as like money you spend rather than assets that you hold. And this again comes back to the idea that existing valuation frameworks for L1s have focused entirely or solely on what the L1 does, how much it moves, how much it earns, what the revenue drivers are. And we tried to reframe this as the real price driver for Sol. Yes, those things are important, but the real price driver for Sol is, think of this as a piece of finite space inside of a thriving digital economy that is growing really, really quickly.
100%. So then, I mean, basically at the end of the day, let's just imagine a situation where we, even as we approach clarity, let's say, like, if stablecoin issuance on Solana is going up, it's now 9.8 billion rolling 30-day. Let's say they start unleashing these things, like we just saw Stripe trying to buy PayPal, Visa ramping up, and all of a sudden we see a 10x in Solana being used by stablecoin, for stablecoin transactions, and we get real, seismic magnitude shifts in stablecoin adoption. How the question everyone always asks is, how does Solana make money? Why does the Sol token go up on a stablecoin transaction? And I think it's good to explain that, because people don't really understand that every transaction, first of all, you need Sol to pay a transaction fee, right? So you need Sol in order to transact stablecoins, even though they're 1-to-1 to the dollar. You also, every time there's a transaction, there's a fee burn. So there's a small burn. There's a deflationary pressure. Correct? Do you want to talk on that as well?
Yeah,
like
let's.
Like $1 trillion of stablecoin and token volume in 2027. Why?
And by the way, it's not crazy, right? Didn't Scott Bessent come out recently and say he thinks stablecoin like market cap is gonna like basically 10x before the end of the decade? And I don't know, all the forecasts we're seeing on Wall Street seem to indicate like it almost feels like bear case for stablecoin market cap at this point is $1 trillion in market cap by the end of the decade. And then question is, how many trillions are we going to? And you'll remember from our chat with the foundation, just a couple weeks ago, Nick indicated their goal for stablecoin TVL on Solana is $100 billion at some point this year. And they're at what, 15 billion right now, Marty? What's the latest figure on that?
No. It's another 500 million today.
Yeah, I mean, I actually like, it sounds crazy because that's like a 6x from here or something like that. But I mean, just look at the historical data. It's been growing like a weed on the Solana network. I mean, absolute weed.
It's definitely a shift. Then we also saw,
so let's talk.
Today, the Kansas City Fed, Jeffrey Schmidt, said stable coins are Venmo on steroids. This is the Fed.
I like that. Venmo on steroids. Venmo on steroids. I mean, I wonder if he was listening to either Parker or me talk about DFDV. We've often said DFDV is Sol on steroids.
Ooh, baby.
Yeah. I won't take credit for that one. That is a Parker ism there.
And then the other thing I spoke to Rob Powell about, obviously, we had a long discussion about monetary premium right in the very bottom at 60,000 when everyone was panicking. And we started to talk about how You know, why are these things being valued as software? Why are they tracking IGV? Why are they
Mm,
seeing as the software which they are? And it's quite an interesting thing. I mean, at the end of the day, they are just software. So everything on top of them just being software is some kind of monetary premium. And I think what we're talking about here is the value of the monetary premium. Now, something like a Bitcoin, that's like the store of value component, right? Everything on top of the software, that's sort of the liquidity in the network. The premium is Bitcoin's monetary premium, and that would basically depend on the trust of the network. And then, but on Solana, it's very different, right? On Solana and Ethereum, these are stable coins issued on the network, plus bridge tokens, like the value of
yeah.
tokens. It's, you know, the value of the real world assets issued on them. The actual
Yeah.
intrinsic value equates to the monetary premium. Do you want to talk
You
about that?
were well, you were really early to this trend, Marty, and I know you've been pounding the table on it, but it doesn't really feel like it's I'm gonna say still widely understood. So I do want to talk about this a bit
Yeah, talk
because
about it.
you know, why is crypto trading in tandem with software? And simplistically, the one liner I've been giving to folks and institutions over the last week is I think it's because the market doesn't quite know what else to do with them. Right. So you're an institution, you're Citadel, you're Millennium, whatever, and you've got to put crypto in a bucket. And the closest thing that you have, frankly, is high growth tech, right? This is why the correlation coefficient between crypto and the NASDAQ for the last few months is somewhere like zero 0.7, right? And probably even higher when you just isolate software. So Sol effectively gets treated like a beta play on risk, right? It gets put into the same bucket as Shopify, Atlassian, Snowflake, Datadog, like risk on, everything rips, risk off, everything dumps, right? And correlations just kind of converge to one. Now, why does this happen? Actually, point number one, I don't think there's really a like good agreed upon valuation framework for crypto, right? So if you can't value something fundamentally, you're going to end up trading it on sentiment and flows. And I actually observed this dynamic fairly early on during my time on the buy side with like I'm going to say the mid cap internet stocks that were often like traded as a basket. I'm talking like the Yelps and Grubhubs of the world because nobody really knew how to like differentiate them fundamentally. They knew they were different businesses, but it was just like I don't really know what to do with this. This to me is just like an insane multiple thing, and I don't know like what cash flow you're going to generate. So I'm just putting you in the same bucket. I'm going to sell you and buy you like all at the same time. And then I sort of think I'm going to say like same investor base, coverage analyst, whatever you want to call it, exists here, which is to say the marginal buyer of Soul and the marginal buyer of like a high growth SaaS name. I think there's a greater intersection there than folks appreciate. And a risk seeking allocator at some multi strat fund or a tech focused hedge fund, right? Like that is the marginal buyer for both of those. So when they are de risking, they sell everything. If they say I'm going to short SaaS, they're like, well, I might as well short IBIT and short like the Sol ETF and short the ETH, whatever it is, right? And of course, as we know, ETFs and these structured products have made it like very easy to put on an expression of this trade and or you know, put on whatever hedge you need to. So that to me is a lot of the fundamental reason why. And then of course you put it very elegantly, like crypto software. So of course, like that's a very easy bucket to just put it all into.
Yeah, absolutely. I think it makes a lot of sense. I also think whenever that monetary premium is sort of traded out, then you know, Bitcoin and all these L1s seem to seek some kind of correlation. Traders become, because there's no fundamental valuations, which is what we're talking about, and no established industry sort of metrics for fundamental valuation. There isn't even like regulatory classification for this asset class.
Yeah,
Then I think, you know, large institutional traders probably search for a correlation. So, I mean, obviously, let's go through them. Correlated, Bitcoin is often correlated with gold. Bitcoin was correlated to the DXY. Now, Bitcoin is correlated to IGV. Is it correlated to stablecoin market cap? And I think the point is, or SPY, right? At times it follows SPY. I think this asset class, and people need to understand, in these novel early stages of an asset class before it's regulated, which really rubber stamps it as a real thing, and which basically signals large flows of institutional capital into it, you're going to see that it's going to search for correlation. And
yeah,
I think it's very interesting how it switches around. But in my opinion, IGV and software is actually a good correlation, because given that GV is also been sold down because of this existential AI risk to these software companies, and the equal existential quantum risk to Bitcoin, these sort of narratives that floated around, I can sort of see it being put into the same basket. But talk a little bit about Solana specifically, and how, I mean, Solana is quantum, has very different quantum characteristics, right? We had Costas of Sui on here once, their cryptographer, saying that these modern networks don't have those same risk factors for quantum, things like that.
Yeah.
So they may decouple from Bitcoin and things. I think that's another aspect of the valuation of these things that people may not be ready for. And that is, we've had this legacy speculative coupling between Bitcoin and the execution networks, when actually they have nothing in common.
Mm.
Nothing. Literally, Solana could function right now without Bitcoin. It's a pure speculation correlation. Can you
Well,
talk
I think part of the decorrelation that I hope will happen, twofold. One, there's the advent of agentic AI, which we could probably spend. That is one of 4 demand inputs to our model, and I have a feeling we're going to end up talking about that one probably the most. But at the highest level, the decorrelation that I'm hope happens is when institutions are able to develop their own valuation framework. So when you can value SOL on its own terms, on its supply dynamics, its the demand sources, the actual free float scarcity, as we call it in our model, then it's going to stop trading like Atlassian. It's going to stop trading like Datadog. And that's part of why we wanted to publish this model, is give people a reason to think about SOL differently, and hopefully help be the force that breaks that correlation a little bit. So again, for those who are probably we're already halfway through, we haven't even like fully gotten into the model. The underlying premise of the model, and I always start with this metaphor because I think it's a powerful one, and it anchors the entire story here, is to imagine that you were in Manhattan back in like the 1800s. I believe the example I used last time I was chatting with you, Marty, was imagine you're standing in Manhattan 1850, right? The island is 23 square miles. It's always going to be 23 square miles, right? There are about 500,000 people living there in that year. It's been growing like a weed, right? But nothing like what's going to happen over the course of the next 200 years. And someone tells you, hey, guess what? Like, in 50 years is going to be, I don't know, 3-4 million people on the island. In 50 years, you're going to, have like a whole subway system that gets established. In 100 years, all the major banks and corporations and institutions that matter are going to want a piece of this island. How would you value that land? And you would have been incredibly short-sighted to say, well, this land, if I buy a chunk of it today, I can rent it out for X number of dollars per month or whatever it is. Like, that would have completely missed the potential of what that land would be worth. So the key again is not to ask, if I set up a I don't know, like a hot dog stand in the corner of New York and sell hot dogs, what is the land worth based off of my hot dog sales? Which again is the emphasis on what is SOL doing today, what is the revenue activity of the network today. You would try to figure out the supply and the demand, and then look at the balance between those two to determine your price. Otherwise, you would have completely missed the fact that, the median home in Manhattan now is like just under $1 million. So the core premise is, think of Solana as a digital city with all this like fantastic activity that is happening today, but that is probably going to explode over the next 5-10 years. And then ask yourself, how much would that piece of land in a digital city like Solana be worth, given all the activity that we think is going to happen? And that is the underlying premise.
Terrific. Let's dovetail quickly into some other little aspects of valuation. Obviously, a lot of people, especially Ethereum maxis, will always say, "Yeah, but Solana is inflation, right? So what are you doing about inflation?" And let's talk a little bit about that. How would you see inflation factoring into valuation? What are Solana's current inflation percentages? Where are they going? What proposals are there to improve on inflation? I've heard about doubling in disinflation from SIMD 0411, right? That's Mert's proposal, things like that. The effects of alpenglow. Like, is inflation a real thing when valuing these things? Do you think that it's not? Is it important? I mean, I know that the initial inflation curve in Solana was created by Tolly and Rob because they thought you needed to stimulate the network in order to get adoption, and it worked extremely well, right?
Right, right.
And at this
Yeah,
point,
it's a great question, right? And especially since like one side of our model is really just asking how much real estate is there in our digital city, right? So, for those who don't know, we've got just shy of 570 million sold today in the circulating supply. Current inflation 4%, with inflation with the inflation rate dropping by 15% until you taper and get to the 1.5% terminal rate. And that's more or less like what we assume in our models. So we assume by 2040 that you're at roughly 750 million SOL in circulation. We don't actually model any of the base transaction fees still being burned, which obviously means that we could be a little bit conservative there. And we also don't model the impact of SIMD 0411, right, which we came out in support of. But for those who don't know, that would double the disinflation rate from the 15% cut to about 30% annually. And cumulatively, our head of research, Pete, had published a report that showed this reduces cumulative emissions by, somewhere more than 22 million SOL. So again, some reasonable, I'm going to say like conservative assumptions on the total supply side of things that we've baked into our model. So, so that's just, I'm going to say baseline table setting. But a key pushback that, of course, we've gotten is like, well, inflation is still kind of uncapped, dilutes holders. How do you like really think about this? And the rebuttal I have is inflation only really pressures price if new tokens actually go and hit the free float. And what we observe is that empirically, stakers continue to hold. And a lot of the like perceived inflation pressure that happened in 23, 24 wasn't really inflation at all, right? So you had like token unlocks from early investors, the FTX state liquidation, etc. And those are one-time events, obviously tied to um, said vesting schedules and the bankruptcy proceedings, and not like ongoing issuance. So the key question to ask yourself is really like, what is the net effect of actual protocol inflation on the free float? And if you think that is going to go towards staking or DeFi or any of the other components of the supply side of the model that we've assumed rather than the free float, it actually should not have an impact on price.
There you go. What is the terminal rate that they're aiming for? I've heard it was like 1.5% or something like that, right?
Yeah, it's 1.5.
There you go.
Is the terminal rate. Yeah.
Terrific.
And again, like the key question is where does that end up flowing? So the way we've thought about this is, all right, take your 750 million SOL in circulation and ask yourself in an end state, in a mature state. Again, we've assumed the year 2040 in here. How much of the supply is like real free float supply? Just like in Manhattan, right? It's not. It would be tough to go and say like I'm going to go and buy JP Morgan's headquarters or something like that, right? It's like that is not available for sale for the average person. You would have to go and maybe you're buying in Hell's Kitchen or Upper East Side, Upper West Side, but there are certain buildings that are just like blocked off, not for sale, part of the economic activity of the city. And it's the same way to think about free float over here. So the first biggest assumption on the supply side is how much of the circulating supply is going to be staked. And this is really like the biggest anchor, in my view, on the supply side of the model. And that staking ratio, if you look at the data, has held pretty firm between like, call it 65, anywhere from 65 to 75% of the total circulating supply through basically every conceivable regime that we've seen in crypto, whether that was going through network outages or the collapse of FTX, right? And simplistically, if you're a staker and you didn't unstake when Sol like cratered to $8, you're not going to unstake for a marginal price move, right? Now the pushback on this is, well, you've got a 2 to 3 day unstaking period. This isn't really a hard lock. You shouldn't be stripping this out from the free float. But again, just based off of the data, it seems like it functions, that like 2 to 3 day unstaking period kind of functions as a hard lock behaviorally. And of course, you have the rise of liquid staking tokens like our very own DFDV Sol, which means that stakers can now retain liquidity in DeFi while still remaining staked, right? So you don't, if you're a staker and you want to go and chase additional yields, you never need to really unstake to access said liquidity, which is probably one of the primary incentives to ever reduce the Sol that is in that staked Sol supply. And now the question then becomes, all right, well, if Sol goes from $90 today to $500 in a year to $1,000 the year after to $2,000, like, come on, aren't there going to be some people that unstake and end up selling their Sol? Of course, there's going to be some natural, I don't know, what you would call it, like, way to model the free float increase, if you will. But you'd have to also think, as price is ripping, that there's going to be demand offsets to some of that supply coming online.
There you go. So I mean, if you just grok this core bull theses, right, then the key points in the valuation include dominant position in stablecoin activity and micropayments. We've chatted about that. Solana becoming the go-to rail for fast, cheap stablecoin transfers of typically USDC, which seems to be issued. Majority of new USDC is being issued on Solana right now. USDT, obviously, and some other ones. And then stablecoin supply on Solana is roughly 17 billion right now. We were a little bit under there. It's 17 billion. The transfer volumes often 2 to 3 times more than Ethereum's, despite lower TVL. And then we touched on every stablecoin transaction requires some Sol for fees, a tiny bit for the base plus priority fee. And obviously, the larger the transaction, the larger the fees. So that creates buying pressure and value pressure. And then as global adoption ramps up, now I understand this will be remittances, payments, institutional settlements, Visa, debit cards. ADP is doing an R&D project to give people the option to get paid their salary in USDC on Solana. I mean, these are insane things. So if people are getting paid in stablecoin, they're not going to leave crypto. They're not going to leave Solana.
Yeah,
They're going to stay.
let's put some numbers behind some of the stuff you were just alluding to, Marty, and then I definitely want to chat a little, spend the last 15 minutes talking about agentic AI, because I think that could be like the biggest upside case in our model here. But according to McKinsey, payroll and remittances volume globally last year is about $100 trillion. Today, stables are less than 1% of that. Less than 1% of payroll and remittances, $100 trillion of volumes. B2B payments, right? Old school B2B payments, $1.6 quadrillion of volume. Stables are around 0.01% of B2B payments today. 0.01%. I mean, where else do you want to go? Global settlement volumes, like 200 trillion. Stables are like 8 billion of that. And for me, it just underscores, like, if we really are poised for explosive growth in stablecoins, again, one of the key demand buckets in our model, I mean, God, all these chains are going to take a bunch of share, but in particular Solana, which of course is the most performant, and is fastest, it's got the best fees. Like, I think people are just severely underestimating, as we all do, right, myself included, like what exponential growth looks like. And this is going to be a really big deal, and frankly is one of the key drivers in our demand model, where, I don't know, we might be conservative. We're assuming basically $150 billion in, like, call it end state demand, which assumes that, Solana gets to about 30% of all global stablecoin flows. And yeah, I don't know. We could be a little bit conservative here.
So you're saying stablecoin transactions are currently less than 1% of the 100 trillion annual remittance and payment market?
Yes.
Wow, that's insane. So if, let's just say that goes to, let's say, 10%, what effect do you think that'll have on stablecoin networks, the the ones that are dominating? Like how
I mean,
how,
if you're
uh,
getting,
how
you
can
get
we
to
start?
10%, you're talking $10 trillion of volume, right? You're talking a 10x right there. And um, I mean, you're getting a little bit into, again, this speaks to just the dynamic I mentioned, which is underestimating exponential growth. I think everyone here is kind of very good at linear, maybe slightly accelerating forward growth projections, but I don't know. Our end state assumption here in the model is like $50 trillion worth of end state volumes. If you got to 10% of this 100 trillion figure, then you're talking $10 trillion of volume right there. And that's not even counting B2B payments, global settlement, like other areas where you'd obviously see an explosion in volumes as well. So,
Put the top of your
yeah,
head. Like, let's say, like, fun. We're probably the first people ever to do this mentally. Like, if there's every 1% of payment of remittance and payment market that stablecoin captures, assuming Solana has, let's say, based on my assumption, I would say 30 to 40% of stablecoin market, compared to Ethereum, all the others that are involved, maybe even higher. What would you say? Maybe 50%.
yeah,
Then
maybe. So if you're assuming 30%, right, 30% share, every 1% is going to get you $1 trillion of volume, and then you assume you're 30%, that's 300 billion. So if stables go from, call it 1% to 10%, you're talking like, 10 trillion total market on global remittances running through stable flows, and then Solana itself just doing 3 trillion of that. And then you have to ask, all right, B2B payments eventually, like this 1.6 quadrillion of volume that's sitting there, of which stables only account for 0.01%, that will change. I think that'll definitely change with agentic AI because it feels like AI agents are really well suited to helping businesses move away from very old school accounts payable, receivable kind of way of doing business. And I mean, that is the pie right there, is like how do you start capturing a portion of the B2B payments volume pie? 1.6 quadrillion.
yeah, I mean, it would be really interesting if we could come up with some math and then track it, maybe with an agentic agent or so, with an agent. Like
I
as
think that's probably like the next iteration of our model is like, of course, we laid out these 4 demand buckets, but now can we double click into each of them? And we probably could write a full-on research report on each of the individual demand buckets, right? We could say, like, let's get really granular and smart about real-world asset tokenization, right? And how big is this asset class going to get over the next 5 to 10 years? And then as we do that research, I imagine we'll fine-tune our base model on what the real-world asset tokenization assumption should be in an end state. Same with stablecoins, right? I mean, we've had some interesting discussion just here in the last 5 minutes on stables, like how can we refine it? And to your point, I think there's some interesting sensitivities there where you can break out all the different, I'm going to say, global value transfer buckets and then say, we think the pie will grow to this, stables will capture this share, Solana share will grow to this. And those are really like the main inputs. And then based off of that, you say, okay, this is how much demand bucket B in the DFDV model should really be worth, right? How much demand will be flowing through into the digital city. And then that brings us to our last subject, which I definitely don't want to leave out. Agentic AI, sir, which is just, that is the one that we don't have a lot of demand assumed in our model because it's just too early. But the stuff we're seeing here is pretty remarkable. You want to talk a little bit about that, Marty? Have you been like playing with some of this stuff over the last few weeks?
yeah, I've got it. I have a project called LQL, liquidation levels. It came from that. The company's name is Automated Intelligence, and we have a couple of devs, actually a team of 2 right now, that are automating my liquidation level strategy using OpenClaw, and
Wow.
we have around a 60 to 70% profit rate per day right now. We haven't
60 to 70% profit rate.
yeah, over about, but roughly averaging around 300 trades a day that the bot actually makes based on the
Okay.
and that's in the down market. We've been, we only just started building it, so we haven't really. Today it just jumped up to almost 80% based on the market. So
Wow.
obviously on a bullish market, it's more predictable. And so I mean, we just started, and we've added agents that go and back test and do circuit breaking based on Donald Trump's real Truth Social posts, on Elon Musk's tweets, on Facebook correlations. We're adding constantly agents that in parallel work with the actual strategy agent to make sure under, critical situations, it circuit breaks and exits all trades, things like that, which you've never been able to do before.
Yeah.
So on 10-10, it would trigger and you would have lost no money. If
Jeez. I mean,
Donald Trump posts anything about tariffs, we exit all trades. Things like that. So we're doing it right now. Small team, young guys. I've got a guy that did his master's in LLM from Brown, and another really good
wow.
guy. Yeah, we're building it out and testing it, and then we will start to apply capital soon.
So let me get your reaction to this, Marty. And I know what your answer is going to be, but right now, all right, bucket A of the demand side of our model assumes basically $500 billion of demand from real world asset tokenization. I don't think like there may be some pushback there. We may be aggressive there, but like let's just leave that bucket alone. Bucket B, we're assuming $150 billion of SOL demand, again denominated in fiat, but $150 billion of SOL denominated demand in our digital city from stablecoin settlement reserves, just based off of the trillions and trillions we think it can get to. Solana capturing, a decent chunk of stablecoin flows, and then having some like SOL reserve ratio, which is we call it the percent of volume that has to be held as SOL at any given time, right? For just operations, etc. For agentic AI, we are assuming about just shy of $30 billion of demand, $30 billion of demand. I want your reaction to that number, Marty. Should that number be lower or higher?
One more time, say it again, exact number again.
$30 billion of demand from agentic AI in an end state for our digital city in Solana. Should that number be lower or higher? 30 billion, 30.
I'll have to put on my my sort of ETF issuer fund, hedge fund hat and say you'd have to have a bear base and bull case.
Yes.
I think the bear case is probably around 20 to 30 billion. I think the base case to me is higher. I think it's 50 billion, and I think the bull case is we don't know. Just like
Yeah.
it's like everything in AI, even the people building AI and working in AI, their expectations weekly and monthly are getting blown out of the water. The network feedback loops and these things are unpredictable at best.
Mm-hmm.
And so I think the bull case is literally unfathomable.
Yes. And
Because these
frankly, that
exactly, they will start to build new use cases we don't even know about.
mm-hmm.
Right? So it's not just applying agentics to what we know. It's unleashing agentics that will devise new business models, new revenue models.
Yep.
You're basically giving them high speed of light, liquidity in which to go and invent new business. And they will do that. And I think that's where the real speculative side of me starts to get very excited. And that is, what are the future agentic revenue models? What if they start creating their own businesses?
Mm-hmm.
What if they what if they make another Amazon?
Yeah.
What if they compete with Amazon with
Yeah.
stablecoin? Right? They just tap into the supply chain, build the UI, replace Amazon, use Amazon. We don't know. We literally do not know.
Yes. And Marty, I mean, this is exactly the point that we're making in our essay. I mean, we say it in the very last section. The number that we've assumed, this just shy of 30 billion, could be substantially higher. I mean, there's just no reliable baseline for how many agents are going to exist, how much SOL each of them is going to hold, what share of agentic commerce and finance is going to go on chain. I mean, we're assuming about 30% of all of agentic finance and commerce happens on chain. What if that's 75 or 80%? What if it's 100%, right? Like, and of course, like, all right, so you assume some percentage moves on chain, and then what percentage is going to flow through Solana? We're assuming 30%, but the early indications, the early data is like actually suggesting a much higher share. So Franklin Templeton put out a report that 70%, 70% of AI agents are, choosing to operate on Solana. That's as of a couple months ago. If you look at the X402 transaction data, Solana is like, absolutely dominating over there. And yeah, this is another area of the model where my hope is institutional investors will download this. And you'll get some folks who say, you know what, I don't really know how to think about this, or maybe I'm in a haircut for my bear case or my base case, and that's fine. But I think you're going to get a folks who are really tracking this closely, who are maybe AI maxis, if you will, who are going to plug in demand that is just substantially higher than what we are currently assuming in our model. And to give a sense of the sensitivity here, right? If we were to do, instead of just shy of 30 billion of demand, we were closer to like, 270, 300 billion of demand, something like that. Our price target for Sol rises like north of 30%. And if like this were, I don't know, let's assume we were going to get to almost the same level of demand as real world asset tokenization, right? So if you're like at $500 billion worth in some end state, like you're almost doubling the implied SOL price in our model. So again, a lot of sensitivities baked into here and a lot of things to think about. But this to me is the one that could really swing it a lot on the demand side, to the upside, right? Because we've not assumed anything, at least in my view, that is too heroic.
Let me give you the Grok's projections. So I did a quick Grok.
Ooh,
Grok came back with the following. It said in the short term, 2026 to this year, currently 5% of DeFi activity, potentially billions of TVL, is managed by AI agents by the potentially. So they're estimating around 5% currently. Stripe's co-founder predicts a torrent of agentic commerce on high throughput blockchains starting imminently but scaling gradually. Medium term, by 2030, agentic commerce could generate 3 to 5 trillion globally annually. This is from McKinsey, with up to 1 trillion in US B2C retail alone.
wow.
Machine
Wow. And you
customers,
see, we're
AI,
assuming 2 trillion. We're
yeah,
well
so there
shy
you
of
go.
that.
3 to 5 trillion. Machine customers, which are AI agents, might control 30 trillion in purchases yearly. This comes from Gartner A16Z reports. Restructuring the digital economy if crypto infrastructure captures even 10 to 20%. This is what I was talking about. We don't understand because these machine customers will dwarf human customers.
Yeah. Yeah.
Remember, human customers are extremely fickle to macro. They're fickle to employment, to liquidity. They have to the fact that we sleep 8 hours a day. We take off the weekends. We go through ebbs and flows. These things will be consuming 24/7, and anywhere they find arbitrage, they will exploit it. And now the only piece that people haven't really got their heads around is that crypto is cryptographically secure and is the infrastructure of the agentic economy. There is no other thing to support it. This stuff cannot use ACH in banking. Literally, this is a potential death blow to the banking industry. This is why the banking industry are fighting like wolves against clarity. This is why they're trying to stall and get a piece of the pie. This is why.
Hmm.
It's agentic finance. And this is McKinsey, Gartner, A16Z. This is not crypto-friendly organization saying this. This is
Yeah.
TradFi.
Yeah. Yeah. Everyone wants a piece of the pie. In fact, I just thought of this one. Sometimes I just think of this stuff while chatting out loud with you, but you gave me the inspiration when you asked me about inflation. I'd rather own the inflationary asset in a city everyone is moving to than a deflationary asset in the city that everyone's leaving.
There you go.
That to me is like the right way to think about Soul and the way we've modeled this out. Now we have literally 2 minutes and then I have to hop because I'm on back to backs here at Strategy World. But the idea that I keep coming back to for this, first of all, the spreadsheet that we have is public. So if you want to download it, www.defidevcorp.com/soul model. And every assumption is there for folks to tear apart. So, if you think our collateral ratios are too high or too low, you can adjust that. If you think the free float should be 20% instead of 10% or 25%, like please stress test the model. Even at the bearish end, depending on, if you think the free float should be substantially higher, the math still implies SOL in the thousands. You could zero out the real world asset tokenization demand. You're going to get SOL in the thousands. And we feel that we've arrived at a pretty good base case of 10K. And again, ultimate objective is to try to get folks thinking about a framework that actually makes sense for SOL. 10K just just happens to be where the math landed. I know we had put out that price target before on sort of a market share relative to global value transfer as well. So these two complement each other in a little bit different ways. But we're obviously, we have this price target because we're believers, have a lot of skin in the game. And our hope is that this model is just one stepping stone towards being able to value Sol a little bit better than some of the existing methods that are out there. So really welcome any feedback you guys may have. Please hit us up. Tell us where things are broken, dumb, where you might have done things a little bit differently, and we'd love to iterate with you.
Amazing. Thank you for your time. That was amazing. DK talking about the fundamental valuations of Solana. You're not going to hear that anywhere else, guys. This is on the front lines of crypto valuation.